Hey everybody, welcome back to another space here on the Jensen X account. We've got coming back to the stage two of our regular speakers, Gabe and Marx. Gentlemen, how are you?
Doing well. How are you?
Doing well.
Excellent, going good, thank you. So we have an interesting topic today in that this is something that you guys have been working on recently, and there's not actually any documentation out there that we can go and have a look at, as it's still something that you're deep in the thick of. The title I came up with was it's relating to the United Frameworks of Market Making and Prediction Markets. Why don't you guys jump in and explain what you've been thinking, what you've been working on under these words?
Sure. Yeah, I'll set up the theme of it, and then Marks, please let's riff on it. But the basic idea is a lot of times the most popular prediction market platforms today, Polymarket, Kalshi, etc., they're based on limit order books. But most of the theory is, and most of the research that's been done in the past is on cost function prediction markets. And this raises a lot of interesting questions that we've been looking into about basically why is it the case, perhaps? Like, is there a benefit? What are the trade-offs of doing this? And how different are they really? Like, what can we expect? And we've been tackling this from a lot of different fronts. And where we've circled to is that they do differ, and in practice, they will look very different. We are personally like we prefer the cost function side of things, which we can get into later. But it actually turns out you can show that they actually reduce into one another. So you can make the limit order book world lobs. We'll say probably lob or clob. We'll probably call them by accident. Limit order book is a bit wordy.
That's going to become a mouthful itself.
Yeah, exactly. So if you hear clobber lob, that's what we're talking about. But we can actually show that given a lob state, so if you take a snapshot in time of a lob, that you can one-to-one map it onto a bunch of parallel cost function prediction markets and vice versa. Which I think gets a lot of really cool results, and it's pretty powerful. And we can also start looking at other angles of this. Like Mark's been looking really deeply into what it means to be a noise trader, what happens when these things coexist, yada yada. But yeah, with that, Marks, please take it away.
Yeah, thanks, Gabe, for the intro. So from my perspective, as more of a econ research person, my question of this this unified framework out, or how do those how can like this AMM side of prediction market and club side of prediction market coexist, comes from my previous research on DeFi, which is in the past all we have for trading cryptocurrencies is just like how we trade those traditional stocks. We use central limit order books, but then out of somewhere, Uniswap, Uniswap came over, right? And then we do not only coexist, but sometimes you can see the volume of Uniswap, like those AMMs, also surging. And in addition to the what we usually say as arbitrage platforms for to those central limit order book exchanges like Coinbase or like Binance, but we're saying that those Uniswaps AMM exchanges are serving some other like
Mm-hmm.
some other functions like pricing oracles too. Sometimes their trading volume is even higher than those centralized order book platforms. So from this angle, I was trying to look at how could prediction market mechanisms also coexist. Just like right now, we only have cloud for prediction markets. And under what condition will automated market making or cost function market makers also coexist alongside of central limit order book prediction market? So that's mostly how I'm approaching this problem, like how Gabe have mentioned, how do we really how do we really model noise trading in prediction market then compared to cryptocurrency trading, how do we model the market making behavior in prediction market compared to traditional equity markets or cryptocurrency tradings. Yep.
Okay.
Yeah, and thanks, Marks, and yeah, like actually, it's funny. This is a good point for me to also juxtapose where like some of the other work that we've been doing is under the hood, which is Marx takes this more like economic view, what happens when they coexist,
Hmm.
what
Yep. Yep.
Oh, I think we've just lost Gabe there for a second.
Yeah, I'm guessing. Yeah.
Looks like Gabe's
Great.
just dropped off for a minute. I did have a quick question while you were speaking, Marx.
Yeah.
What brought us to this question? Why do we need to even look at the difference between clubs and A&Ms for a prediction market?
Yep. Yep. So I think one
just
thing.
a
Yeah.
question in my back.
You
Oh
are
yeah,
back.
you're
Yes.
back. You're back. You're back.
Welcome.
Yeah.
Okay.
Yeah.
That's good questions. I was about to start yapping about when that was weird. I could hear you guys and it's showing as if I was talking. But anyway,
Oh, preempted your question.
yeah. So that was well timed, Xavier. Yeah. No. All I was going to say is that like there's this angle that what Mark's saying is like what happens when they do coexist is more of like a traditional econ question, and how do you model this? But you can also study it, which we have been, which is why should they coexist, and what is even the point? What's the juxtaposition you get? Well, this gets really interesting and really fascinating, and they actually play off each other. What Marx is talking about, and what I'm bringing up now, in a really weird way. It's like his is like essentially saying like what happens in practice, and the other is like why should they happen in theory? And it's a very elegant story when you start piecing it together. Um, First of all, there's a bunch of guarantees and so on, which we'll get into in a second. But I think one thing that immediately gets revealed is that when you start to ask these questions and look into them, you reveal that the roots are actually all interconnected. There's like one giant set of roots, and then like they all pop out in different ways, but they actually are the same thing in this weird way. So Marx mentioned AMMs and traditional equity markets. What's really fascinating is that the equity markets, when you start studying the cost function markets, they actually are equivalent to the constant function markets, which are like Uniswap and these other DeFi sort of swaps that we like to think about in DeFi. And then now they're also equivalent to these limit order books. So it turns out that they're all kind of the same thing. And if you build infrastructure with that in mind, they kind of start to cross-pollinate in really interesting ways. And then why do they even differ in the first place? That's, I think, your question, Xavier, that we're just getting into. And then like that comes down to a bit of like, it's a trade-off between like three things really. One is like accuracy. The other is expressivity. And the third is market maker loss. And there's some sort of like no free lunch thing going on here where you can't say, I want perfect accuracy, nobody will lose money, and very simple expressivity, right? That's not possible. You have to give up one of those things for the other two to start being able to develop. And by studying these things as one framework, it starts to reveal itself, and you start to see where that trade-off really comes from and why it's worth having them side by side. I would say it has to do with also like what you're looking to get from these markets. For example, and we'll get into this in a second more deeply, but if you have the limit order books and you have agents trying to learn off of limit order books, they're in some sense playing a weird zero-sum game against each other, which is known to be chaotic and very, very hard. It's going to hurt your learning. Whereas if you have a cost function prediction market, it imposes certain guardrails where the market can sort of serve as a barrier for the learning on the agents. It also serves as a barrier that allows the market itself to learn and be more accurate. What is that? Why is that the case? It's because in a cost function prediction market, somebody needs to escrow some funds that will take the counterparty to any trade. Therefore, an agent that's rational and informative is always incentivized to go and produce information. Whereas in a club, they need to think, oh, well, how much volume is there? Will a market maker be there when I need it? What's the current market state? It's a lot of thinking before you ever even inject any information. And then by the time you do, everyone else has to think, is that information or is that arbitrage in some way? Are they doing some other weird thing? Whereas in the cost function prediction market world, it's very, very clear. They traded because they have information. There's nothing else. There's nothing else dangled in there.
Is some
But
of
yeah,
that
did
to
you
do
have
with the
any?
sequential nature of the order book?
Yeah, yeah, it's exactly. It's basically with the order book, you can come in and out at will. The only people who can come in and out in a cost function prediction market, or at least in the traditional version of them,
Hmm.
is the traders themselves. So it's basically the sequential nature on both ends makes it really complicated,
Okay.
and it makes it a worse information aggregator. But there's other reasons as well, which Marx can get into really really eloquently on the liquidity side, which really ties into what he's been looking at.
Yes, please, Marx.
Yeah.
Tell us about liquidity.
Yeah, sure. So I think, well, let's circle back to the this analogy I draw from traditional crypto equity markets. So basically, a lot of people see Uniswap as a way mainly for arbitrage because uh, when when the when people post their orders of buy and sells on central limit order books, it basically signifies that they're willing to buy or sell certain coin at a certain price. And then when that happens, you see in Uniswap, if nobody trades with a pool, then basically the price doesn't move, right? So
Right.
as Gabe mentioned earlier, it's usually the price in central limit order book move first, and uh, then for people who kind of observe this what we call arbitrage opportunity, they will either buy from the Uniswap and sell on like central limit order book, or they buy from central limit order book to sell on the Uniswap. So I think that's so the liquidity here is basically if you think about like liquidity in central limit order book is that whether this buy order or sell order has a counterparty to basically take your order, right? But then when you
Right.
go to the liquidity in AMMs or those Uniswap pools, is how much of your order will how much of the buy and sell will affect the price. So basically two different I would say two different concepts of liquidity in either side. So I think that's how we understand liquidity in AMM and central limit order books. And then when we look at this problem from a prediction market point of view, it has a lot of similarities, right? The way of trading or the way of posting orders on central limit order book is the same for both prediction market and and the equity market. But then when you think
Hmm.
about the payoff of those equity or payoff of those what we call like prediction market yes no shares, it's a bit different because if you trade on the so basically if you buy your like Bitcoin on either on those Uniswap pools or on uh, central limit order books, it is unlikely that so if you swap your USDC with for a Bitcoin on Uniswap, like neither of your USDC or Bitcoin's value is gonna go to zero, right? Like it's very unlikely.
Right.
But if you think about prediction market, one side is eventually gonna go to zero, right? Because there's only one thing with like yes or no cannot be happening at the same time, basically. So that you see that's the difference between prediction market like prediction market and traditional the equity market. So in equity markets, when you trade on those really popular pair of assets, it's very rarely that one of them going to converge your value, like one of their values going to converge to zero. But then when you look at prediction market, it's a bit different. So that's why we need to rethink the liquidity provision problem in prediction market. It's not like you put down a market maker put down some cash and then just wait until for people to exploit it, right? So how do
Hmm.
we really design those markets? How do we uh, disentangle this market making incentives in prediction market? Is very very important when we study the like coexistence of both mechanisms.
to to add a little bit of color to what he's saying as well, like in another way, it's current limit order book market making is basically it requires noise trading fundamentally, and it requires noise trading the same way that it would happen in equity markets.
Hmm.
It doesn't require noise trading the way that you would expect in a prediction market for it to be very lucrative or profitable or make sense. Um, this leads to a weird paradox, right? Where in a prediction market, you want it to be a good information aggregator, not necessarily an exchange venue, which is what Marx is saying is the difference. You're not exchanging assets to one another or anything like this, because one of those assets is fundamentally going to have a value of zero.
Mm.
So what happens when you don't design around this is that you now need to get your prediction markets to look more like those equity markets rather than making those things look more like prediction markets. So that's where all the work is being done. And that leads to this weird, it manifests in weird ways. And when you start looking at coexistence, what you start to discover is like a really weird paradigm on who's aggregating the information actually when these two things live side by side. Yeah, anyway, just to color what Marx is saying in a slightly different framing, in the pure liquidity setting. Yeah, go ahead, Marx.
Yeah, that's basically what I want to say. But thank you. Yeah.
That's it.
Well done, Gabe.
Um,
What
one thing that wasn't mentioned though is that like I was leading a question there, which is that basically like in the if you have a costing prediction market in a lob, what Marx has shown is actually that uh, the lob is not the information aggregator. It's in some sense like an arbitrage exchange venue, whereas the cost function is the thing that's actually aggregating the information. Unless I'm misremembering the result, Marx,
Yeah,
but
that's
I
correct.
think that's what you
That's
found.
totally
Yeah.
correct. Yeah. So basically, in that model that I'm writing down, I think it will be kind of public in maybe next month, sometime next month. So
Mhm.
so when both like venue coexist, then those AMMs will essentially become the venue for aggregating information, and then the club will be a venue for them to like extract those value from noise trading and prediction market. But we model the noise trading and prediction market in a different way rather than like in the traditional equity markets. I think so. Let me mention a bit. How do they model like noise trading in traditional equity markets? So if you think about like traditional equity markets or cryptocurrencies, those currencies or those equities, they do have some what we call outside value, which is maybe a little bit unrelated to the current price, right? Sometimes people like, let's see, if you're buying, let's see, some like Tesla stocks, you're probably looking for like bonuses, or you think it's going to have a long-term growth. You're just trying to diversify your uh, I don't know, investment or something. So basically that's what we call some outside utility or outside information. So just
Right.
by holding the stock, you will have something else rather than the price changes. Like you're benefiting from arbitraging between, like, let's see, buy low and sell high, right? So you have something else. And for cryptocurrencies, it's also true is that it sometimes give you some governance rights. It give you voting powers or something. But if you think about those outcome shares, yes or no shares in prediction market,
Yep.
they don't really give you those kind of outside utilities. So it's hard for me to argue for any economic reasons to argue that they are buying this for some it's hard for me to convince myself at least to model those noise trading in the traditional sense for prediction market. So that's why we're seeking a different way of modeling like noise trading in prediction market.
Okay. I'm interested in where this is going to go for prediction markets, the markets that we're putting together, and what's coming down the line based on this kind of theory. But just very quickly, for myself and any others, can explain what you mean by noise trading. We've mentioned it a few times.
Yeah, sure. So in traditional at least in finance or econ literature, when we talk about noise trading, we're talking about those traders who trade irrespective of the price information. Let's see.
Okay.
Let's see. At this moment, some let's go back. Like pick whatever from like that. Let's see Tesla stock right now is like $500, but
Mm-hmm.
then there's some inside information where people know that it's going to release I don't know, like a yearly report and like an annual report, quarterly report that's going to show it has really good like return forecasting or whatever. And
Mm-hmm.
so in those people's mind or with their private information, the actual value of the stock is like 550. So that's why they're buying at 500 so that they can either sell it to 550 or because the fundamental value of the stock has shifted, but nobody has ever like, but the price right now is 500, but the value has already increased, right? So when we talk about noise trading, is that those people don't care about the they care about, let's see, I wouldn't say they don't care about fundamental value of it's being 550, but they don't know it. And they have some information. So they have some, the demand comes from those traders that don't know about the fundamental value of this stock right now. They just want to buy it for some other outside reason that we don't model explicitly in the paper. Those are noise traders.
There's a non-normal reason for them wanting to trade.
Yeah. So so one example is that even the price such that like even if the stock right now becomes like 570, which is higher than the fundamental value, they will still buy it because they have some outside information. So basically, in the traditional model, like noise trader are acting as someone who's on the like the I don't say the losing side of the trade somehow. Yeah, so you can think of that way. Yeah.
Yeah, there's actually a very famous like it's like a pretty core result, I think it's from the 80s, called the no trade theorems. And what they say is basically without these noise traders, informed traders don't come in because if it's only informed traders, they look around and go, well, I can't assume they're less informed than me, so I'm going to lose money. So they require the noise traders to exist for them to know to come in and kind of scoop up earnings and yield. Yeah. They play a pretty fundamental role in people using them.
If you don't know who the fish is at the table, you're the fish.
Yes, exactly. So the classic thing is people say when these markets is don't worry, they're a bunch of fish. So you probably aren't it. But yeah.
Oh, very good. No, thank you for that little sidetrack. We're getting close up to the half an hour shortly. What is this all going to do for prediction markets for Delphi for us in the future? How do we see this research playing out?
Mark, do you want to go first, or should I take a stab at it?
Yeah, you can take a stab at it. Yep.
Yeah. So in my mind, it's actually pretty multifaceted. On the one hand, it tells us, what kind of markets are interesting for people to make within Delphi. How should they structure those, et cetera, given that there exist other platforms out there. So that's part of the coexistence work. But I think there's a lot of other information that comes out of this in terms of what type of market mechanisms make sense for us to implement going forward? Are there new ones we should consider and design around? Because by exploring these things as a unified framework, which is not traditionally done, you basically start to walk around that spectrum between accuracy, market maker loss, and expressivity, right? You can kind of bounce around, explore that space, and design mechanisms with that trade-off in mind, and try to figure out where exactly is the sweet spot. And lastly, I think it informs how we should probably go about building some of these things, and some of this infrastructure, because if we build it correctly to tap into this unified framework, then basically your infrastructure works for all three, right? It cross-pollinates very naturally. And similarly, and vice versa, the infrastructure that already exists for all these different things can be used for us as well. So you kind of get a lot of very efficient work going on there. The classic example of this is like the entire liquidity ecosystem around AMMs. If we build this correctly, that whole ecosystem basically just taps into our stuff for free, so to speak. Right. And they cross-pollinate really nicely, which is cool. You can see one is like the ecosystem for exchanging assets, and the other is for exchanging information. And they really are just like two mirror worlds of one another, which is really a really cool thought experiment to run down. But.
Yeah, maybe one thing I want to add is since we're trying to build the network of machine intelligence, we're trying to figure out like what kind of market mechanism, like when put together, are best for models to really learn about the world somehow, right? I think so. What kind of mechanism gives a good signal for models to learn from? Yeah.
That's a really good point, Marx, actually. I was going to say that, like, one thing we've been looking into as well is, like, how do you learn in these things? But the other side is when you have many of these markets coexisting, how do you get them to essentially learn a world model together in some sense? And we already have some very strong results in that vein, where if you have the cost function prediction markets, their corrections actually, when correcting markets, essentially you pool all their liquidity together. So if you have 1,000 markets with 1 cent each, or let's say 100 markets with 1 cent each in them, and they're all correlated, correcting these 100 markets actually is worth $1. Versus if you had you're not just making 1 cent, right? You're making 100 cents all at once. You kind of pool liquidity by correcting them. And vice versa, because of Marx's work on the coexistence, basically we can show in this that you're indirectly pooling liquidity with all these clubs. But what we're doing is they're exchanging, basically we're taking liquidity from them and information, whereas they just take information from us. And information
Right.
is a public good in our design. So it seems like a good exchange in our direction. But yeah.
Fantastic. No, that's really, as you said, a thought experiment. It's a fascinating thing to let your mind wander down and where this is all going to end up. What is the future, Gabe and Marx, under this topic? What do we see happening in some years' time?
I think we'll get some very concrete mechanisms that pop out of them, and also a, a coherent like porting of basically importing the theory from each of them in one place, and really getting a shake out of what that gets us. Um, yeah, and that's not even including the stuff that we build off of the insights from this.
Absolutely. Marx, any last thoughts to leave people with?
Yeah, I think that's all for me. But yeah, I think Gabe has spit on everything. Yeah, I want to say. But
Yeah, you can think of this if you want the one sentence takeaway. This is the theory of how markets can form a world model. I think that's the way to think about this in some sense,
yeah,
and how they are one coherent model together.
yeah, or maybe market is I would more efficient, or maybe is it too strong of a statement? But yeah, somehow it's a really efficient way of forming a world model. I wouldn't compare it
Yes.
to others, but it's really efficient. Yeah.
Yeah,
Marvelous. Fantastic. Thank you both. Always a pleasure having you guys around. Um, really enjoyed that little afternoon. And thank you everybody for coming along. We'll have the recording available shortly, and keep an eye out for the next couple of these that we schedule. Gabe and Marx, thanks
thanks,
very much.
Xavier, and thanks, folks, for
Thank you.
coming on Monday.
Yeah.
Yeah,
Thank you
Cheers,
bye.
guys.
everybody.